All right, guys, what's going on? Welcome back to another episode of the Real Estate Investing Q&A show. I am your host, Chris Grenzig. Thanks again for joining me. For this week's episode, I am in the new office. This is our conference room, or what will be our conference room, where we're going to be doing a lot of filming, either here or next door. So get used to it. It's going to be different, but it's going to be good. So yeah, finally moved into the new office. Super pumped. Happy to be here. If you haven't already seen, awesome new setup. Go check it out on Instagram. I love it. Really, very happy to be out of that office. Very happy to be in this one. So it's going to be good. What else is going on? We closed Columbus, so that was fucking amazing. Some hiccups at the end of the road. Lender was kind of fucking around with us, but we got there. We got it done, so that was good. And now we're working on 92 unit deal in Jacksonville. We're working on another 500 units in Columbus. We're about to have one under contract and one we're going to go under access agreement. We're going under access agreement. Well, first off, an access agreement is basically saying, hey, we've agreed to an LOI, but before we draft up or while we're drafting up our PSA, which takes time and money, let us spend 2 days and get in there and let us see the property and see if it's something we like or want to do. So they're going to let us get in there before the actual full contract is signed, to kind of view everything. It's one we're borderline on. We're not super crazy on. It's really, really tiny units, but it's a super low price per door. So it's interesting. So one we're about to sign contracts on in Columbus. The other one we're going to do an access agreement on. So we'll be back up there. Jacksonville will probably close by the end of November, I would think. Yeah. End of November? Yeah, end of November. And then we actually got one other deal in Jacksonville we're working on right now. Fingers crossed, hope it comes through. Really, really nice deal. Really awesome location, and a really good purchase price. So really happy about that. What else is going on? Oh, our podcast is about to be live. You're probably going to be seeing this when it's already live, just because of the delay, but super excited for that to be out. We've got 8 episodes recorded. We tried to do one yesterday with Sonia. It didn't work, but we got Rod Khalif tomorrow, so hopefully that works out. Sonia's going to be back on. We got about another 10 people lined up over the next couple weeks, so we're going to be pumping those out regularly, doing it bi-weekly. We got a great company editing for it, for us, hosting it for us, so really pumped to offload that. That's really it. Before we get started, if you like this video, liked other videos, it would be awesome if you would subscribe, like the video, recommend it to a friend, whatever. If you have any questions you want to see on future episodes, be sure to drop it in the comments. Shoot me a DM on Instagram. Hit me up by email, chris@tororep.com, and I will use it for future episodes. In this week's episode, I'm going to do way more than 3 questions, and I'm going to try to answer them way more shorter. So I'm going to cover more topics. I'm going to be way more succinct, even though I tend to ramble a little bit. I'm going to try. I'm only going to try to spend a couple minutes on every question. Get in, get out, move on to the next. So with that being said, first question of the night. If it would do my face. From Instagram, what would you do with $500,000 in real estate at the moment? For me, what I would be doing and what I am doing is rolling it into our multifamily properties and then also allocating money towards the company. And we're also trying to get into mobile homes and land flipping. And the reason I would do all those different avenues is, one, multifamily I think is still a fantastic asset class despite where we are in the market cycle. I think it's very recession proof, and I think as long as you don't over leverage the property, go out and get too much debt that you have to keep your occupancy high, your rents high, things like that, you should be able to sustain through a downturn, and it's going to be a great place to park your money for the next 2, 5, 7, 10, 15 years. Mobile home parks, I think, is very similar in regards that it's even lower on the totem pole for rents, so it's super, super recession proof. It's also a cash flow play, so you're not buying it and trying to increase rents significantly like you often are in multifamily, especially in the value add or opportunistic space. For us and for most people buying mobile home parks, you're buying it to cash flow as is, so you're not changing a lot. So with that being said, you should be able to sustain any downturn in the cycle. Obviously, if unemployment goes to a bajillion, everybody's screwed. But if things don't get too bad, you'll do better than most, especially compared to the stock market, luxury rentals, vacation, office, retail, etc. So really like it for that. Also, I really like land flipping as a play right now. I think it's very interesting because it's basically wholesaling or flipping single family, duplexes, residential, multifamily, but without all the fucking messiness of the actual property. Basically, it's just a numbers game. You send out as many mailers, get in contact with as many owners as you can. You offer 20 cents on the dollar for what it's worth, and you try to sell it for 80 to a full dollar. And it's just a numbers game. So you're not coming in, you're not really improving the property. You don't have to, you don't have to clean it up or fix it or make it nicer or do anything like that. You are buying land for way less than what it's worth from people who just don't want it anymore or can't afford it if they have taxes that are overdue, and you're selling it for a lot more. A lot of people will sell it for less than the full value, so there's a big buyer pool and you can get rid of it quicker and you're not stuck on inventory. But I think that's just a great way over the next couple years to try to build up some cash really quickly. So that's what I would do if tomorrow I had $500,000. Next. How do you source your deals? Do you look yourself or do you have a group of brokers you work with? 80-90% of the deals we find is through some sort of broker relationship. We don't do a lot of direct to owner stuff on the large multifamily because let's say I spent 2 hours every day cold calling, direct mail, all that stuff, how am I going to do a better job than a broker who's doing it for 10 hours a day? So especially as you get into larger space, it's a very small, tight-knit community. There's not nearly as much inventory as the single-family space, small multifamily, duplexes, quadplexes, triplexes, things like that. So because there's significantly less inventory, it's way more known in and around who's doing what. And we usually know 98% of the time if a deal is up for sale, off market, on market, whatever, in areas we're looking at, in asset classes we're looking at, because you just start hearing more about it. A lot of people put out feelers before they actually list deals. So it's very rare we don't hear about a deal before it gets traded. So for that reason, we do a lot. Now, we also do buy deals through other relationships. So we bought our 2 deals in Jacksonville through our property manager. She facilitated from one of her clients to us, and that was the way we were doing it. You could also leverage your insurance guy, your mortgage lender, your accountant. Ask them if their other clients are thinking about selling, have assets they would sell, and would you put them in contact, and kind of play intermediary or just make an introduction. So you can leverage those other things. I do think there's still a great opportunity for direct to owner acquisitions or purchases less than 50 units, not including New York, Miami, whatever, because the dollar amounts are so big. But if you are looking for smaller multifamily, 10 to 50 units, there are still a ton of mom and pop owners out there that you could get directly in contact with, that even the brokers and agents that are doing it aren't nearly as sophisticated as your large groups that are selling 10, 20, 50, $100 million deals. I just don't see it happening in that space unless, you're at a conference and you're talking to another owner and it just happens to come up and you happen to put 2 and 2 together. So, yeah, that's how I see it. We're doing it mostly through brokers, other professional relationships. Okay. Again, it was a request, not even a question. Make a video on limited versus general partners. And just to clarify more, what's the difference, I guess? Who has more risk, responsibility? Who has more equity? Are limited and general partners individual people, or are they other firms? So a limited and a general partner is in our investments. When you set up an LLC, everybody is a partner. It's just what type of partner are you? The general partner is basically saying the person who has control of the property, the operations, the investments. So anybody on the general partnership side is kind of the managing member of the LLC or the deal. The limited partners are giving up the control to get passive income. So the risk involved for limited partners is, do you think the general partner can do what they say they're going to do? Also, some of the risk is, what does the contract you sign look like? Do you waive all rights? Do you waive all rights but criminal acts? Do you waive all rights but, a majority vote to get them out and get somebody else in? Do you actually give up all control, or, is there voting rights for major decisions? So there's, gray areas in the general partnership and the limited partnership that goes into it. So just because it's one way or another, there's actually a sliding scale between the two of how much control you actually give up and have on the GP side, general partnership, or the LP side, the limited partnership. General partners and limited partners can be companies or individuals. There's big private equity funds that invest as a partner in a deal, and they will be a limited partner. Generally, those bigger companies will invest a large portion of the equity. So 60, 70, 80, 90% of the total equity. The general partner will come up with the difference. And usually that limited partner as a company, a private real estate fund, will give up control except for like major decisions. So they'll have final say on sale, on refinance, on major capital items, on changing the business plan, on large changes in budget, etc. So that's where I was talking about how much control do you give up. These large groups that are 70, 80, 90% of equity in these syndications or in these funds, they will have more control. They usually give up almost all the day-to-day stuff, but any big decisions that affect their investment, they want to have a say in. So that's where that can come into play. I'll just kind of end it there, though, because it could go on for a while. How big of a role does cap rate play in your decision to go after property? What are some of the other big factors that you'll look at? Another thing, what cap rate would you typically want to see in a lower? I feel like I did this question. I'm not really sure. I'm going to answer it again anyway. It might be a repeat, but very quickly, cap rates are based on asset class, what the property's like, location, market, how much value is left on it, etc. So identical properties in whatever market, if this thing is fully renovated, maxed out, you cannot get any more rent besides, just kind of what the market does, inflation, 2%. This deal versus a deal that is 50% below market on units or rents are going to sell two very different cap rates. This is going to be way higher because it's stable. There's not much I can do. This property is going to be value add and is going to sell much lower. The reason for that, the idea behind a value add property is you can take the cap rate you're buying it at, let's say it's a 5, just for example's sake, and it's a 5, you can bring extra money to the table. So now your cap rate on total dollars is actually less than 5, but because you can improve the property and push rent so much, your operating cap rate, your future net operating income divided by your total dollars is going to go up way above that. So it could go 6, 6.5, 7, 7.5, 8%. And why people like that is because cash flow on commercial properties basically boils down to your income minus your expenses gives you your net operating income. Your net operating income minus your mortgage is your cash flow. Your cash flow, let me rephrase that. Your cash flow on a commercial property basically boils down to your income minus your expenses gives you your NOI. Your NOI in the future divided by your purchase price gives you your operating cap rate. You make more money the wider the gap is between what you borrowed in debt versus your operating cap rate. So let's say hypothetically in that scenario, you bought a property and it was a 5 cap all in. Your total cost was 5%. You also borrowed your money at 5%. We'll say interest only to make it very simple. So net, it's almost like you bought that property all cash. You would make 5% on your equity. If you can get, and let's say, again, for example's sake, you borrowed 50% of all the dollars. You would probably never do that, but let's say you do for simple math. If you got that property up to a 10 cap rate, you would make on your equity the same 5%. So for 50% of the property, you would still No, I'm sorry. You would now make 10%. So for 50% of the property, you would make 10% because that part of it you bought all cash. The other half that you borrowed money on, 5% of the 10% that the property makes goes towards the debt. The other 5% goes to you, but gets added on the 10% you're already making. So you're jacking up what you're going to make. That would be, if I'm doing the math right, 15%. So that's how, I think it might be higher. I'm not sure, but you get what I'm trying to say. Basically, because the debt is a fixed return and your property is returning money over that fixed return, you keep it and it multiplies your return as it goes higher and higher. So that's how that works. I got 3 more questions I'm going to take from Bigger Pockets, and then that'll be it. I feel like I'm at a good pace. How long have we been going right now? I'm going to look. 17 minutes, but I was a little long, so it's probably not even that long on your side. Excuse me. Take a sip of water quick. All right, here we go. Last 3. I've got a single family home that sits on a large lot. It's big enough that I could build a duplicate of the house next to the original. I would love to use the land and build the duplex since I already own it. How could I finance this? Would I get a construction loan and then later refinance with a mortgage? Advice needed. Thanks. So going by this question, if you built a duplicate house next to it, just to touch on this, would not be a duplex. Duplex is, because you're segregating the lot, it would be 2 single family homes. You're just subdividing and building something else. I think that's a great option. The problem you run into is going to be on any building ground up. Can I do this? Can I do that? It's going to depend on the local government, the zoning, the land usage, all that fun stuff. And that shit is either very easy or a clusterfuck depending upon where you live. So hypothetically, it's a great scenario. In reality, it's significantly tougher. It takes time. It takes public meetings. It takes hearings. It takes zone approval. It takes permits. It takes architectural drawings. It takes actually subdividing the land. You got to make sure you have the right zoning for that area. You've got to have the right, frontage from the street and access. It's so much stuff you have to look into. It's very convoluted. If it's something you're thinking about doing, if you're thinking about building, developing, ground up construction at all, and you have little to no background, go get help from somebody, whether it's an attorney, an experienced builder, someone in the county's office. Ask questions. Make sure you know what you're doing before you start spending money, and find out if this is actually viable and how viable it is before you start spending money to go to zoning and permits and drawings and things of that. So not as easy as, it's not just, hey, it's my land, I can do whatever I want. There is ordinances and zoning you have to obey and abide by. Next question. I'm just switching screens, so that's why it looks like I'm looking at something. All right, next question. I'm ready to invest in some small multifamily units with 2 of my brothers. We have been discussing the upside potential of shared investment costs. We have discussed less about potential pitfalls and headaches of partnerships in general. The dynamic of family partnerships have potential to be dicey also. I'd like to think that my brothers and I are reasonable, would be able to work out potential issues along the way, but things always come up in partnerships. I'd like to create a solid structure and written business plan to avoid any miscommunication or unmet expectations of one another. Any tips, books, blah, blah, blah. So my tip to you, Brandon, and everybody else, whether it is family or general partnerships, always have an agreement written down, signed, and in place, because there's plenty of examples of people getting into partnerships and it does not go according to plan. So definitely recommend you have something structured beforehand. The point about certain expectations is huge. Any partnership you go into, whether it's a joint venture, a formal partnership, starting a company, doing business with family, knowing your roles and responsibilities before you go into it is so critical. If you don't, your expectation could be very different from somebody else's, and it could lead to fights, arguments, disagreements, things like that. So whenever I've been involved in a joint venture or a partnership, our roles and responsibilities are outlined to some degree beforehand on what we're going to do. A really good example was the 82-unit deal in Jacksonville we bought. It was John, myself, my mom, my cousin, and Tom. And Tom was the one who founded the deal, And that was kind of his role and responsibility. And he found the deal. He was given part of the general partnership, and then he was along to learn. The other four of us, John was by far the most experienced. So he was the one, all the big picture stuff, putting it together, getting the debt, helping with the investors, making sure everything was fine and dandy, great. I was helping with a lot of the due diligence stuff, and then I was going to operate the property as soon as we bought it. I did not really have the investor database at the time. I didn't really have any way to contribute towards the loan with my balance sheet, and didn't have a ton of experience at the time. My mom had the balance sheet, had some investors, could work on that stuff. Anthony was willing to put time and energy into the equity, the due diligence, travel, and operations. So some overlap, but we all had general responsibilities and roles, and we were comfortable not having super delineated and penciled out roles, but it's really up to you if you want to do that. So know yourself. You know, before you go into a partnership, if I need to have written down my 6 roles and things I'm going to do day to day, week, month, yearly, do that. If you're more comfortable being a little bit loose, that's fine. Definitely still outline what you're going to be handling for this partnership. Definitely don't just go in, especially if it's family, because that's tough, and just say, we'll figure it out, outline it beforehand. And the very last question of the evening, I've been seeing quite a few fractured apartment communities being marketed lately, and these have always turned me off due to their complexities and challenges. Have you ever underwritten or acquired one of these types of communities? What are the pros and cons that you see? And this is from Dan Hanford, so I actually know pretty well, so it's an interesting question. So he called it a fractured apartment community. I've usually seen it as a fractured HOA or a fractured condo. And basically what a fractured condo is that you can acquire is there is a condominium association, which is basically an apartment complex with multiple owners. And it, by fractured, it means that you can buy a large percentage of the units that are being rented. So it might mean 80%, 60%, 90%, whatever it may be. And there's still an HOA in place because there's multiple owners, but you own most of the units. You usually own most of the seats on the board, so you have the ability to make most of the decisions. The pros and cons of a fractured condo is the cons are you still have to deal with an HOA, so you have to keep 2 different sets of books, one for the HOA, one for your investment. 2, you have other owners on the property, so you have to deal with that. They might live there, they might rent there, so you have to deal with all that. Even though you have control of the property, or you fucking should have control. If you don't, definitely don't buy it. It's not worth it, unless you're buying, 2 fractures at this, whatever. Don't. Where was I going? You still have to deal with other people on the board, even though you have control. You can't just tell people to fuck off, I'm doing what I'm doing, because people always have ways to make your life harder than it needs to be. So you still have to kind of play the politics game with the other people on the board. The pros, though, is a lot of times because it's less desirable. Oh, another con, you can only get stable agency financing, I think, if you own 80% of the units or more. I don't know that for sure. Definitely double check with a lender, especially if you're looking at one, but I think that's what it is. The pros, though, a lot of times you can get units for cheaper because it's less attractive. So if you're in an area you really like and there's deals selling for 100, 130 a door, you might be able to pick something up for 50, 60, 80, 90K a door. So you're getting a discount because of that. Another pro is taking a fractured condo, which is a great business plan, and buying back the rest of the units, creating one unified apartment complex, dissolving the HOA, and now you have that complex as a whole community. So one of the best deals that John did that I came on right as they were selling it, they turned $900,000 into $4.5 million by buying 72 of 80 units in a fractured condo. They bought back the other 8, did a ton of renovations, sold it for a silly low cap rate in a super high appreciating area, and made a fuck ton of money. So fractured condos have a lot of opportunity, but it's not always the easiest thing. Another fractured condo that we looked at, we did not buy for a couple reasons. One, we found out that the condo market in the area was not very good. There was not a lot of movement. Deals sat on the market for a lot of days. There wasn't a lot of people that were looking to sell, and it didn't feel like there was going to be a lot of opportunity to buy. The other reason, and part of the reason I think this was attributed to it, most people in the community, it was like 60-70% of the units. The rest were still owned by people that had bought it back in 2006, 7, 8, right as the market crashed for like $250,000 to $350,000. We were buying all the other units or looking to buy for about $100,000. So for us to buy those units back, there's no shot. If they hadn't been foreclosed, and no units had been foreclosed on, so it was all doctors, lawyers, high-income guys that they bought this thing. It was on the water, beautiful fucking property, probably would sell for 160, 170 unit, renovated and as a single community. But there's no way these guys were going to sell for probably less than what they bought it, or a huge discount, because they would have done it already. They would have moved on, whatever. It is what it is. So we didn't feel that there was a great possibility to buy back these units for a similar price and not kick our cost bases up way huge and still make a profit. Now, if it was, we could buy 60% for 100, buy the rest for 200, and we knew we could sell it for 300 a unit, different story, but that wasn't the case. So the ability to buy back units in a fractured condo, which makes them really attractive from that business plan, you've got to look at what they were bought for and what you want to offer for. And if there's a huge discrepancy, it may not be super easy to buy them back, especially if you've got people who don't need to sell. They can hold out until you hit a price that they want. They are not super motivated sellers. And just like anybody that's in wholesaling or flipping, motivated sellers is the name of the game. But one tactic you can do to try to help force through sales is, if you are buying an older community, you're doing a ton of renovations, because it is an HOA and you're doing renovations, they have to chip in their fair share of the renovations. So their HOA fees can go significantly higher, and you give people that heads up and let them know and say, hey, I'll give you fair market value for your place, but your HOA costs are going to go through the roof. If people are renting those out to other tenants, you're now screwing with their cash flow. So that's why I always tell people, or recommend to people, not to invest in single condos, because you are solely reliant on your cash flow based on what the HOA dues are. And they could go up, they could go down, but you don't have control over that unless you have a seat on the board. And then even still, you're one of how many. So I don't like that from a single family rental standpoint. But if you are the majority owner, it is a tactic you can use to try to incentivize people to sell. But yeah, that's it for this week. I think this was episode 11. I'm going to be honest. I don't even know. It might be 12. I think it's 12. Pretty sure it's 12. But yeah, that was it. I did way more. I did shorter. I would love to know which version you like better. Do you like 3 questions with longer answers and I kind of ramble on? Do you like, I think I did 7 questions. Or do you like, 5 to 8 questions shorter, get them done quicker? The video's a little bit longer in length, but I think I went through more and touched on more topics. I would love to hear what you think. If you want this shirt, make sure you hit up Anton Martel. Sick shirt. Love it. $20. Tell him I sent you. Super comfortable. Love it. Going to be wearing it all the time. Had to wear it for tonight. And that's really it. If you guys don't already follow me on social media, make sure you do. LinkedIn, YouTube, which you're on, Facebook, TikTok, Instagram. I'm on all of them. Go hit me up. If you want to be notified when our podcast is going out, go to thereiexp.com/podcast. Sign up for the newsletter. When it goes live, it'll also be up there. Also, be sure to check out the REI Experience YouTube channel. Check out the Toro YouTube channel. Check everything out. It'll be in the description below. We're putting out tons of good content, at least in our opinion, and trying to do more. So check it out. If you like something, let me know. I'm always looking for feedback. But that's it. Thanks for watching.